Do you want to become a successful investor and learn smart investment techniques? Then you've come to the right place. In this video, we'll be learning in detail what is value investing and the success formula of value investing. The term value investing was coined by Benjamin Graham, but adopted and popularized by the legendary investment gurus Warren Buffett. Hey everybody, and welcome to my channel, Money Invest. Don't forget to subscribe to our channel. Don't forget to press the bell icon so you don't miss out on any other valuable content and informative ones too. Let's first understand what is value investing. According to Benjamin Graham, Buffett's professor and mentor, value investing is an investment technique that involves buying stocks that appear underpriced or are trading at an amount lesser than its intrinsic value. In simple words, it's like purchasing a new AC at considerably low prices during off-season when its demand is low. Even though the product and its feature remains same, but the price varies according to demand and thus giving handsome profits to buyers. Similar strategy is followed by smart investors in the stock market. Stocks also go through the similar process of price fluctuations according to market demand. Even though companies' value remains the same in the long run, but stock price reduce due to low demand or overreaction of market. Stockers take advantage of the situation and thus make smart investment and get lucrative rewards in return. This is how value investing works. So value investment is the process of analyzing, exploring, and studying the stock market and investing in stocks at discounted price and getting rewarded handsomely rather than paying full price for the particular stock. Now with this knowledge of value investing, let us learn the secret formula of value investing adopted by Warren Buffett. Before we begin, it's important to know that there is no concrete formula or equation adopted or followed by Buffett. He follows few strategies to make smart investments. Let's learn in detail about his investing strategies, which has led to his incredible success. Number 1, he stresses on knowing the business or market very well before investing. Whenever Buffett buys a stock of a business or few stocks of the business, he always looks at it as buying the complete business as a whole. He always calculates the risk involved by asking few questions to himself, such as, what benefits will he get in return if he purchases the stocks of the business, and when will he start getting the expected result? He explains it through an example that a bird in hand is worth 2 in bush. But before leaving the bird in hand, we have to be sure that there are 2 birds in the bush, and how much time will it take to get those 2 birds? So Buffett always looks at companies as a whole rather than focusing on supply and demand intricacies of stock market. According to him, a smart investor always invests in companies that always show robust earnings and long-term growth potential. Number 2, determining margin of safety. According to Buffett, we should always have properly calculated margin of safety. Value investors should always have room for error in their estimation and always set margin of safety for risk tolerance. In addition, Buffett never advocates taking loans to buy stocks. He's not a big fan at all of margin debt. According to him, if an investor has understood a business and the future of the business and is pretty sure of its success, then there's little room for margin of safety. But if an investor is taking risk of investing in a volatile business, then he must have a greater margin of safety. He explained this through a simple example. It's like crossing a bridge that can hold 10,000 pounds on a truck weighing 9,800 pounds. The risk involved is less if the bridge is just at a height of 6 inches. But if the same situation is over the Grand Canyon, then we will need a greater margin of safety by riding a 4,000 pounds truck or something across. So the margin of safety depends on the nature of the underlying risk that one is taking, and is an added advantage to reduce the losses and make trading safer and less risky. Number 3, calculation of intrinsic value. Before we begin, we should first understand the meaning of intrinsic value. As we have already discussed earlier, that stock prices of a business or product or assets keeps on fluctuating due to high or low demand in the market every day. Prices might go up 3 to 4%, or it may come down 4 to 5% on daily basis. This fluctuation in prices can take place due to various factors, like the prices of a business or product such as a shampoo or perfume may rise up. If there's a rumor that Ambani or Tata is going to invest in a particular product, or the prices may come down if there's a rumor that they're trying to sell the stocks and come out. But this change in prices of stocks doesn't at all lead to any change in the overall worth of a particular company, and thus variation in stock prices does not have any impact on the real value or worth of a business. And this real value is termed as intrinsic value. Smart investors always invest in stocks after calculating and carefully analyzing the real value of the business rather than depending on the stock market prices. Now let us understand what methodology is used by Warren Buffett to determine the intrinsic value of a business or company. Buffett always looks for the cash inflows or outflows of a business, from the business to the owner and from the owners to the business in the upcoming, just say 100 years, and then discount the cash inflow or outflow to the present day. This gives a number to the intrinsic value of the business or the product in whole. Intrinsic value is just an estimated value and not an exact figure with 2 or 3 decimal places. While investing, Buffett does extensive research of the business or the product and then calculates owner's earnings. The formula used for calculating owner's earnings is reported earning plus depreciation, depletion, amortization, and certain other companies' non-cash charges minus the average annual amount of capitalized expenditure of plant or equipment, etc., that the company requires to maintain its position in the upcoming years and maintain its long-term competitive position. So we can see that the calculation of owner's earnings is rather simple and easy. Besides the calculation of owner's earnings, several other calculations such as maintenance capex, free cash flow, net income growth, etc. are made by Warren Buffett. These are calculations that help him to determine the intrinsic value of a business or product and thus tempts him in investing and gets benefited in return. Value investing is all about calculating the intrinsic value and buying stocks at prices below the value, resulting in long-term benefits. Number 4. Learn not only from one's own mistakes, but also by mistakes from others. And last but not the least, Buffett says that we should not only learn from our mistakes, but also from the mistakes made by others. A smart investor always learns from the mistakes done in investing by other investors. He explained this by quoting US General George Patton and says, "It's an honor to die for one's country, but we should make sure other guy gets the honor. So we should try and learn vicariously." Buffett has also made mistakes, but he learned from it in a great deal and made sure not to repeat them in future, and thus safeguards himself from falling prey to wrong investments and suffering from losses in the long run. In a nutshell, value investing is all about knowing the business in which one is investing very well, researching and finding out about the long-term returns that investors will get, setting an appropriate margin of safety, and very importantly, calculating an approximate but to some extent accurate intrinsic value of the business or company. Warren Buffett says that the best investment that one can make is the investment in yourself. The more you learn, the more you'll earn. So believe in yourself, have patience, and never cease learning. Patience and determination are the keys to success, and that's the foremost principle of Buffett. We should not panic by petty losses in trading, but learn from the mistakes and focus on long-term gains. And with this, we come to the end of our video. Comment down below to tell us what you think are the other value investing formulas adopted and followed by Warren Buffett, which has made him one of the most successful investors of all time. Make sure to like and share the video and subscribe to our channel, and we'll bring you more amazing, and make sure to press the bell icon so that you don't miss out on any of our awesome content. See you soon with other awesome content on investing and other related topics. Till then, take care.